Welcome to the deep dive. Today, we're focusing purely on the numbers, on the strategic facts and financial drivers behind Alphabet's dramatic 2025 turnaround.
Yeah.
We want to look at this from an investor's point of view to really understand what pushed that stock so high and, completely changed the narrative.
It was a monumental run. I mean, you're looking at a stock that started from a March low of, about $145?
$145, yeah.
And then it just rockets to a high of $299.66 in November. That's a 50% year-to-date gain.
Which is incredible. It put Alphabet way up there, even remarkably ahead of NVIDIA's 35% return.
Right.
But that story, that growth, it was anything but a smooth ride. If you think back to the start of the year, investors were genuinely running scared.
Oh, absolutely. That Q4 report, it showed the cloud revenue miss. They brought in $11.9 billion instead of the expected $12.1 billion.
And the growth was slowing down, too, from 35% down to 30%.
And, the initial slowdown wasn't even the biggest fear. The real terror was that planned capital expenditure.
The $75 billion.
A staggering $75 billion commitment to build out AI infrastructure. And at the time, the market just saw that as a massive short-term profit killer.
So that's the crucial link, then. That huge gamble on infrastructure caused all the early panic, but then the Q3 results came in and showed that the spending wasn't a profit killer at all. It was.
This is rocket fuel. Precisely. That Q3 report was the absolute turning point. Revenue hit $102.3 billion, just blowing past the $99.9 billion expectation.
And the cloud numbers.
Crucially, cloud revenue didn't just meet the target, it accelerated. It showed over 28% growth.
Wow.
And that really cemented its place as the company's second largest source of revenue.
Okay, so if the massive spending led to that win, what were the mechanics behind it? How did they manage to turn CapEx into revenue growth so quickly?
Well, we saw two key drivers. Internally, they kept iterating on the Gemini model, which boosted search quality. And that translated directly into higher click rates.
Okay, so a direct ROI there.
Exactly. And then externally, the critical thing was supply. The GPU shortage started to ease up.
Ah, right.
And that allowed Google Cloud to finally service these huge hyperscaler contracts that had been stuck in a backlog, including, some initial deals with Microsoft.
But even with that operational success, the market still needed something more, right? Some external validation. And that de-risking event came in September.
The antitrust ruling. Yes. Everyone was afraid of a forced breakup.
A catastrophe.
It would have been. But the court only required sort of partial open access to default search protocols. It avoided the worst-case scenario.
And the stock jumped?
Jumped 15% in a single week. It was just instant relief. And that relief was, of course, later ratified by the Buffett effect.
Right. Berkshire Hathaway disclosed a new stake?
A new $4.9 billion stake in Q3. That's 17.8 million shares.
Which is fascinating. I mean, if the fundamentals already looked so good, why did the market seem to need that final seal of approval from Buffett?
It was all about the valuation context. After that ruling, the new money flowed in because the stock's relative value was just so attractive.
So it was still seen as a bargain.
Kind of, yeah.
Yeah.
Even after that big rally, the 2026 PE ratio was around 26.9x, which is, significantly lower than Microsoft's 31.8x. It signaled stability and still a lot of potential upside.
So the core takeaway for an investor here is that Google is no longer just a search giant. It's a proven AI plus cloud dual engine.
Exactly. And that cloud growth at 28% is now closing the gap on Amazon's 21% pretty quickly.
And what's the outlook now? Analysts are modeling, a path to $400?
Path to $400 by 2027? Yeah, as long as the company can maintain that 20% compound annual growth rate.
Yeah.
The risks haven't vanished, of course.
No, you still have the ongoing regulatory probes in the US and EU and that constant pressure from high AI spending.
Right, but the execution risk has been drastically reduced.
Ultimately, this whole 2025 comeback story really highlights a kind of systemic resilience, doesn't it? It's not just a pure tech bet.
It's not. It's anchored by this irreplaceable ecosystem. You've got search, YouTube, Android's billion-plus users, and all of it is now being powered by AI.
Which brings us to a really critical question for you, the investor.
Are you betting on the pure high-acceleration play you get from a specialized hardware maker? Or are you betting on the strategic endurance and, the vast ecosystem penetration you get from a giant like Alphabet?
Based on 2025's results, that choice is now clearer than it's ever been.